Part 1. Most traders stare at charts and ask one question. Where will price go next? They zoom in on candles. They change time frames. They draw lines over lines. They wait for confirmation that agrees with what they already want to believe. They are not searching for clarity. They are searching for comfort. My data forced me to ask a different question. Who is in control? Right now, that single question changed how I trade. Because when you stop asking where price will go and start asking who is moving it, everything slows down. The market becomes quieter. Your mind becomes calmer. Your decisions become cleaner. Trading stops feeling urgent and starts feeling observational. When I built my scanner, I was not trying to predict price. I was trying to remove myself from the decision. I noticed something uncomfortable when I reviewed my losses. The problem was not that I lacked tools. The problem was that I was always involved. I had opinions. I had expectations. I had impatience. Emotion was my biggest enemy. Every bad trade I reviewed had emotion behind it. Fear of missing out. When price moved fast, fear of being wrong. When price pulled back, fear of doing nothing. When the market looked active but unclear, emotion always appeared before the entry, not after the loss. Data does not feel fear. Data does not rush. Data does not hope. Data only reflects behavior. That is why the first mindset my data taught me is that volume leads. Price moves. Because money moves. Candles are the result, not the cause. Indicators react. Volume participates. When dominant volume is bullish, buyers are committing capital. When dominant volume is bearish, sellers are committing capital. That commitment is control. That is not an opinion. That is participation. It tells me who is active and who is passive. My job is not to argue with that. My job is not to outsmart it. My job is not to predict when it will change. My job is to respect it until it changes. Every time I fought dominant volume, my data punished me. Losses increased. Execution worsened. Emotion returned. Every time I aligned with it, results improved. Not instantly, not perfectly, but consistently. That is when trading stopped feeling random and started feeling structured. That is when probability began to matter more than prediction. Part 2. The second mindset my data forced me to accept is that structure is confirmation, not prediction. Not opinion, confirmation. Support and resistance are not lines I draw because I feel confident or because they look clean on a chart. They are areas where price already reacted, with real volume and real participation. They exist because something already happened there. Structure is memory. It is the market remembering where effort mattered and where it failed. When structure holds, the market is defending. That means buyers or sellers are willing to absorb pressure to protect that level. When structure breaks, the market is committing. That means defense failed and control has shifted. That information tells me more than any indicator ever did. Indicators react to price. Structure explains behavior. Indicators tell me what already happened. Structure tells me why it happened. A market moving up without structure confirmation is weak. It may look strong, but it has no defense. It is moving because there is no opposition, not because there is commitment. A market pulling back, but defending structure, is strong. It may look weak, but it is being protected. That distinction changed how I interpret price. That is why probability is never fixed. Probability is not a number. You decide once. Probability changes as information changes. A bullish market can lose structure and become fragile. A bearish market can lose pressure and become unstable. That is why I score probability instead of making decisions. The score is not a signal. It does not tell me to buy or sell. It gives me context. It tells me how aligned the market is with volume and structure at that moment. The higher the score, the clearer the environment. The lower the score, the more uncertainty exists. Low probability means no action. That mindset alone saved me more money than any winning trade, because most losses do not come from bad entries. They come from trading when clarity does not exist. Another mindset my data forced me to accept is that doing nothing is a valid position. Most losses did not come from bad analysis. They came from forcing trades when probability was unclear. When my scanner shows neutral, I stay neutral. No bias, no anticipation, no urgency. Patience stopped being a weakness and became a measurable edge. Waiting became part of the system, not an emotional struggle. Part 3. Another hard lesson my data made unavoidable is that bias must follow data, not confidence, not experience, not past success. Bias is not something I decide in advance. Bias is something the market earns. Bullish continuation is not a belief. It is a condition that must exist. It requires dominant volume. It requires structure alignment. It requires confirmation. Without those, bullish bias is just hope. Bearish defense is not fear. It is structure. It is the market showing that sellers are active and buyers are failing to regain control. When conditions disappear, bias disappears immediately. No attachment, no hope, no ego. That mindset removed the need to be right. I stopped defending ideas and started observing behavior. Once bias followed data, risk management became automatic. High probability does not mean high risk. It means clarity. Clarity allows controlled risk with clear invalidation. Small size keeps emotion out. Defined loss keeps fear contained. Repeatable logic keeps execution consistent. Before entering any trade, I already know what invalidates it. That rule alone changed how losses felt. Losses stopped being personal. They became informational. When invalidation is clear, panic disappears. There is nothing to debate, nothing to argue with. Either conditions hold or they do not. Over time, this mindset changed everything. Trading stopped being exciting. No adrenaline, no urgency, no emotional swings. And that is when it became consistent. Consistency came from alignment, not prediction. I no longer try to be right. I try to be aligned. Aligned with volume, so I respect control. Aligned with structure, so I respect memory. Aligned with probability, so I respect uncertainty. That is what my scanner represents. Not a signal machine, not a shortcut, not a prediction tool. It is a decision filter. It filters emotion. It filters impulse. It filters bias. It allows me to participate only when conditions are present and step aside when they are not. If you want to see how I apply this mindset using real scans, real markets, and real probability logic, subscribe and comment. Probability. Remember this. The market does not reward prediction. It rewards discipline. See you in the next video.